John Crypto here, and if you think you can trust your eyes, consider this. Silver just lost $44 in 21 days. That's right, from about $109 to $65 an ounce, a total bloodbath throughout the precious metals market. But here's the thing, it's not just numbers on a screen. In that short time, $7 trillion in market value disappeared from derivatives, ETFs, and the paper markets like a financial neutron bomb went off. The iShares Silver Trust, SLV, also took a hit. Assets under management fell from $55 billion to $44.7 billion. And if you think this is just a retail panic, the COMEX open interest jumped to 182,000 contracts, clearly signaling forced liquidations. Every leverage position caught in the crossfire, every retail margin call, suffering while the big players smiled behind the scenes. Now let's talk about the lie the media wants you to believe. Headlines shout, silver crashes due to weak demand. Investors flee as ETF inflows dry up. They portray this as a normal market cycle, a temporary setback, maybe even a buy-the-dip chance for the average Joe. But here's the honest truth. That price collapse was engineered, and the retail panic was the weapon of choice. While everyone else is running away, Morgan, BlackRock, and a few institutional whales are quietly hoarding physical silver and SLV shares at deeply discounted prices. They caused the $44 drop by triggering a cascade of liquidations on leveraged retail positions. And the media narrative? Just a distraction to cover up the theft. Here's what most people don't see. The volume reveals the story the headlines won't. SLV's one-month average trading volume is around 168 million shares per day, but during the crash, unusual spikes occurred exactly when the price plummeted. Coincidence? Not a chance. Meanwhile, COMEX futures are out of control. Paper contracts far exceed the actual physical metal, creating artificial volatility that allows these institutions to manipulate the market without ever handling the real thing. And the proof isn't hidden. It's right there in CME COMEX delivery notices. Physical withdrawals spiked, with tens of millions of ounces disappearing from vaults while prices crashed on paper. Now, connect the dots. Retail investors are trapped. Panic selling is what fuels this fire. The average trader, thinking they're cutting losses, is unknowingly feeding the very institutions that are accumulating metal quietly behind the scenes. ETF outflows, almost all retail accounts. Meanwhile, institutional inflows are hidden. The smart money is quietly taking possession of real silver while everyone else watches numbers drop on their screens. Here's the thing. This isn't just a flash crash. This is a textbook retail trap, perfectly orchestrated. Every $1 drop triggers margin calls. Every paper contract sold pushes the price lower. Meanwhile, the banks scoop up physical ounces. And we're not talking a few million, we're talking hundreds of millions of ounces quietly accumulated while the world panics. You're seeing the financial equivalent of a bank vault being emptied, except the public is forced to fund the withdrawal through fear. But wait, it gets worse. You think this volatility is normal price action? Look at SLV inflows and outflows. Retail panicked and pulled millions of shares, but these outflows were immediately replaced by institutional purchases, effectively giving the big players a free pass to accumulate real silver while the paper price crashed. And on COMEX, futures contracts are still stacking faster than deliveries can be made, a ticking time bomb of paper versus physical imbalance that ensures the next rise could make this collapse look small. Here's the tease that should worry you. COMEX vaults aren't just dipping, they're losing silver at a rate no chart predicts. Physical metal is being drained faster than it's produced, faster than the ETFs can adjust, and the synthetic price drops are just hiding the real story. If you think this $44 collapse was bad, wait until you see the inventory numbers. The next chapter reveals just how empty the vaults really are and who's controlling the last ounces. This isn't a market correction. It's a calculated liquidation designed to trap the uninformed and enrich the invisible few. And when we look at the next piece of the puzzle, the supply chain, the vault withdrawals, the paper versus physical divergence, you'll see why the West isn't just losing silver, the East is quietly buying everything they can. The question is simple. Will you be left holding the bag when the vaults are empty, or will you see the play before it's too late? The numbers are clear, and the smart money is already far ahead. But if you think that $44 bloodbath was the end, consider this. COMEX warehouse inventories have plunged 25% in just 21 days. That's about 50 million ounces of silver gone from the vaults, disappearing faster than anyone expected. London vaults aren't doing any better. Allocated bars are delayed, some shipments outright missing, and the whispers from bullion banks are loud. Physical metal is drying up. Meanwhile, SLV and SEVR holdings continue to show withdrawals, even as prices hit multi-week lows. That's right, real silver is being drained while paper contracts scream panic on every screen. Here's the thing, the leverage trap is brutal. Paper silver derivatives outnumber physical metal 8.1. That means for every ounce you can touch, there are 8 phantom contracts being traded, manipulated, and liquidated. And those forced liquidations, they didn't just influence the price, they accelerated the 44-cent drop, creating a cascading waterfall of margin calls. Smaller traders were devastated, whereas the big players were acquiring every bit being dumped onto the marketplace at a steal. Picture this. BlackRock and JP Morgan were operating discreetly around the $65 mark, gobbling up SLV shares as if they were kids in a sweet shop. It wasn't just a bit of purchasing, it was obtaining actual silver using exchange-traded funds, bypassing the mess of paper to hold solid metal. The figures don't mislead. CMA delivery reports reveal that organizations pulled out over 15 million ounces in just the last 3 weeks. Movements of that magnitude don't just occur. The following is where it becomes unethical. The price drop wasn't a market adjustment. It was a tactic created to frighten smaller investors, drive the price lower, cause fear, trigger margin demands, and subsequently quietly purchase the cheap metal while everyone around is shouting and unloading. Typical manipulation, perfectly done. The panic selling by smaller investors becomes the organization's reward. Consider the historical context. This is a scenario that has been repeated since the inception of paper silver. Do you recall 2008? The financial collapse wasn't merely the downfall of Wall Street. It involved manipulating gold and silver on paper, triggering liquidations, and creating the impression of an unbound market decline. Jump to 2020, silver surged, the paper squeeze occurred, and institutions departed with huge holdings as smaller investors were sidelined, still examining charts, attempting to comprehend artificial instability. This is the identical strategy, only larger, quicker, and more unforgiving. Here's the information most won't reveal to you. Every spike in SLV and SIVR disposals during this crash is precisely aligned with big players gathering more. They're profiting from your anxiety. They're converting your panic into earnings. At the same time, paper derivatives continue to be dominant, magnifying every decline, every cascade, every forced liquidation. Smaller investors are stranded with worthless contracts, while the informed investors obtain real, physical metal that the earth is gradually exhausting. This is a painful revelation. It's not just a story exclusive to the US. While the West is stocking up on silver as if it is going out of existence, the East isn't just sitting around. Shanghai premiums are spiking. Physical bars are being transferred at a premium of $1,251.50 above the NY spot price. This isn't betting, it's genuine demand consuming the world's supply, slowly but noticeably. Central banks and global investment firms are joining the action, quietly stocking up, protecting against a dollar that is losing its grip, while smaller traders in the US and Europe are occupied with being squeezed. The COMEX and ETFs are simply the venue. The real narrative is identifying who owns the remaining metal. Each forced liquidation, each sale caused by panic, each paper contract flattened by artificial leverage, all of it directs solid silver to big players who understand the true dynamics. And as vaults in the West empty, the East is carefully increasing its metal reserves at a premium, setting up the subsequent significant phase of this international manipulation. Here is the shocking conclusion. As the West gathers and the East steps up its activity, international movement is occurring more rapidly than anyone can monitor. Shanghai premiums, ETF reassignments, cross-border deliveries. Each of these points to a highly volatile truth. The upcoming phase won't focus on a paper-silver collapse. It's about identifying who will possess the physical metal when everything calms down. The statistics are showing it. Vaults are emptying, withdrawals are skyrocketing, and artificial instability is concealing actual scarcity. If you believe you've witnessed manipulation before, be prepared as we reveal how movements between the East and West are subtly changing the silver market's regulations. While the West obtains silver as if it's a depleting wealth, the East is secretly initiating a countermove that you're not seeing on CNBC. Shanghai premiums currently exceed the NY spot price by 1.25 a strong signal that Asian purchasers aren't just passively watching, they're desperate. ETF inflows in Asia are increasing by 12%, despite continuous SLV outflows in US, discharging precious metal back to institutional hands. Every metal unit leaving COMEX and SLV in the West is arriving somewhere in the East, where purchasers agree to pay the extra charge to avoid the irregularity of paper markets. Also consider this: the purchasers consist of more than just hedge funds or personal investors. Central banks and sovereign wealth funds are subtly transferring mass amounts of silver, shielding against a dollar that is progressively losing credibility. On-chain observers indicate that mysterious digital wallets are acquiring billions of dollars worth of silver, transfers so significant that they minimize standard retail flows. We're not considering simple stacking. This is accumulation performed at the state level, controlled silently as the smaller investors' world trembles over losses on paper. Remember that strategic realignments are fueling a portion of this. Export limitations in significant mining regions, sanctions implemented on countries with big supply reserves, and logistical bottlenecks are strongly increasing scarcity. Meanwhile, US and EU banks proceed to manipulate artificial instruments, futures, ETFs, paper contracts, with the goal of keeping smaller investors out of the action when they're hedging real holdings quietly. They have created a fortress of paper that hides the factual inadequacy, but the basic truth is undeniable. Physical silver is harder to find than it's been for years. Pressure in the supply chain isn't theoretical, it's intense. Mining is getting more difficult, smelters are subject to regulatory oversight, and transport is trapped at bottlenecks. COMEX and ETF disposals are outpacing actual silver mining, causing an extensive inadequacy that even optimistic charts fail to capture. Every forced liquidation, all panicked ETF sales in the West, are supplementing the East, an arbitrage that isn't an accident. It's a designed, silent international struggle for dominance over the metal. Here's the wider consequence. Silver is rapidly morphing into its role as a protection against the dollar. Elevated premiums in Shanghai, together with extreme accumulation by central banks in China, India, and the Middle East, are rewriting the conventions of international currency hedging. While these Wall Street gurus make much of byproducts and written agreements, governmental players at the state level are tying up tangible possessions which might one day put the US dollar's control to the test. The Eastern world isn't only procuring silver, they're unobtrusively gathering security against comprehensive breakdown. Here's something many folks completely overlook. The ebb and flow linking the Eastern and Western worlds aren't impacted by pricing alone. They're impacted by command. Every sliver of an ounce drawn from COMEX, every hard asset extraction from SLV or SIVR, every on-chain million-dollar digital wallet movement is rebalancing supremacy. The West presumes it's in control of the account, but the East is quietly amending it. As vaults become bare, as ETFs have to be liquidated, as written agreements meet their parameters, the Eastern world will have secretly secured the real bullion, while the West is stuck with manufactured contracts that don't mean anything during a crisis. The suspenseful piece that will have you dumbfounded. The push and pull between East and West isn't exclusive to silver. They're guiding toward an unavoidable universal settlement. A monetary concussive wave that will reveal the delicacy of the structure overall, where immaterial tools fail, fiat is discredited, and concrete possessions such as silver all of a sudden determine who endures and who is eliminated. The figures don't mislead. Tangible silver shortage, central body amassing, fabricated paper control, all uniting at the same instant. When this showdown hits its high watermark, the West will see that keeping watch over price action is purposeless if what's real isn't what you have command over. The narrative broadens in the following stage: bond markets faltering, debt skyrocketing, the Federal Reserve printing as if it's the end of the world, and silver arranged as the noiseless way to skirt a collapsing arrangement. Once you see the comprehensive image, you'll see why the real trouble isn't a $44 reduction. It's the structural crash that causes the East-West maneuvers to come off as warm-ups. The comprehensive reality hits like a speeding locomotive. The US burden has gone beyond $40 trillion. Japan's bond returns are rising quicker than anyone expected, and pressure in the universal monetary arrangement is stretched to its very limit. Every ineffective dollar, every forced settlement, every fabricated contract that has heavy influence in the silver market is a sign of something about to break. As average investors are alarmed regarding ETF draining and costing trends, sharp institutions are secretly regarding silver as a hedge, a safety net against the purchasing value corrosion of fiat. Here's the curveball. The Federal Reserve is out of alternatives. Printing is no longer a plan of action, it's a snare. Every additional infusion to take care of shortages only intensifies the fire, locking in inflation explosions that will cause today's $65 silver to come off as a steal. What about paper markets? They might have disguised shortage levels up until now, but manufactured contracts cannot conceal actual scarcities for good. Once East and West have secured real ounces in their vaults, these paper figures will equate to nothing. Silver is not simply increasing, it's set to explode higher in a way that will astound anyone still holding on to charts and ETFs. Unite the pieces, the system is defective, byproducts dominate tangible markets, and the common investor is unmindful while cornered in the snare of panic selling, margin requests, and untrue accounts. Meanwhile, educated financial backers, including banks, state assets, and covert wallets, remain in absolute command, accumulating real silver while you're cornered in paper fallacies. This is not control, this is a survival strategy in a collapsing arrangement. The figures hint at the following: blend tangible shortages, East growth, and institutional hoarding, and you secure a medium-term silver objective of $90 to $120 an ounce. This number is conservative relative to what could occur if a debt or currency shock hits. Those who possess only paper will feel the tightness, those with real ounces will calmly get away, and the divide between seen and actual value will expand turbulently. Here's the brutal reality. The choice is at your doorstep. Stay in the banks, sit in manufactured contracts and hope the arrangement holds, or assume command of your holdings into self-keeping silver. ETFs are handy, but their value is determined by the institutions bolstering them. True safety comes from holding the tangible metal in your hands, stored safely, unexposed to paper control. Here's the ultimate truth. As the arrangement finally breaks down, freedom isn't judged by your bank sum, your digital values, or your margin record. It's gauged by what you genuinely possess. Silver is more than just a metal, it's autonomy. It's a safety net, a lifeboat, and silent revolt against a failing monetary order. Each extraction, each growth, each East-West action you've noticed over recent months drives you here. Banks were in command of the alarm. The arrangement was in control of the charts, yet real assets win when paper fails. The enlightened folks who saw the signals, stockpiled ounces, and understood the process make it to the other side. Everyone else is fixated on a monitor, bewildered by how $7 trillion vanished and why vaults containing their holdings are unoccupied. If you've been on the trail, uniting the data bombs, the COMEX draining, the Shanghai rewards, and the macro debt winding, you're already notified of what's on its way. Silver isn't just rising. It's about to remind the world just who is in control of actual holdings, and it won't be the piece of paper market participants. It won't be the ETFs. It will be the owners of concrete, verifiable, tangible silver. Consider this a warning, not a forecast or a suggestion, but a full-fledged alert from the inside. Leave the banks, leave any paper snares, and safeguard your freedom in metal. When the arrangement collapses, the only certainty of survival is something you have the ability to touch, keep, and hold. Silver is more than just money, it's liberty. It's the ultimate barrier between you and the collapse which the banks wish remains unseen.